What's going on, everyone? Welcome back to Malibu Investing. My name is Andrew, and today I'm going to provide you guys with a little bit of a stock tutorial, more so options on how to trade them, what they're all about, and things like that. So let's jump right into it. So if you have Robinhood, the first way that you're going to want to kind of set this up is by going and clicking your account right here, and you're going to want to go to settings, to which this menu will pop up right here. Then you're just going to want to select option trading. If you don't have it enabled, then you won't necessarily see this, but you'll see kind of like a little financial quiz or a little questionnaire that you have to answer. In order to enable options, you do have to answer the questions a certain way, but if you fail to do that, just simply refresh the page and then redo the quiz or whatever that's called. Once you do have options enabled though, you're going to see this little sexy little button right here. You can just click trade options. And so for today, we're going to be looking at Apple. I think it's a pretty familiar stock to everyone. And so right now the price, if we start from the top left, it's Apple. If we look at the price, it's 131.9 or 131.90. Next to that is how much it went down today. So Apple actually went down 1.2%. And so in order to trade options, I got to kind of explain what each thing is. And so obviously the buy and the sell, it's pretty straightforward. You know, if you want to buy a certain call or put, if you want to sell it because you already own it. And there's more things you can do with these buttons actually, but we won't go over them today. We're just going to go over the basics. So getting into it, a call option is where you predict the stock is going to actually go up. And so if Apple right now is at 131.9 and we think it's going to go up, we'd get a call option. If we think it's going to go down, we'd click this button right here that says put, and boom, all the put option chain, loads. And so it looks like that. And then right here is simply the expiration date. We'll get more into the expiration date here in a second. But first, before I do that, I wanted to describe something that's called in the money and out of the money. And it's very essential to know this before we jump back into the expiration and stuff like that. So if I have a $100 bill, and my buddy Chris comes up to me and says, "Hey, Andrew, can I have $110? I'd say, unfortunately, man, that's actually outside of the money that I have. I only have $100. But if he comes up to me and says, "Hey, Andrew, can I have $50? I'd say, yeah, man, $50 is within the money, is in the money that I have. And so what that means is if you look at a stock like this, like Apple, where it's at 131.9, right? $131.90 out of the money on a call option would be anything above it because you're predicting it's going to go up. So out of the money would be above it, right? This is not within the money. Within the money would be down below. So all these are in the money. And a proof of kind of concept or a way to double check that is simply looking at these options and realizing that always when things are in the money, they're going to make you more money quicker, but they're going to be more expensive. And so if we scroll down, the more in the money we get, which is what we look at the strike price right here, the more these options get worth. So the way that options work is every single time you buy one option, whether it's a put or a call, you reserve the right to 100 shares of that company. So what this means is because you're reserving the right, that means that 100 shares are in play. And so if I were to buy something like this $131 call for $1.45, you actually have to multiply this number by 100. So one contract of that is 100 shares each. And so the final price or the max cost is 145. This right here is the price that you're going to put in for it. And so this is the spread, it's the ask and the bid price. And so typically right here, it's just the average between the two. It's the range. And so it's the big number minus the small number equals that. And it's kind of the middle number that, Robinhood predicts you could probably get this contract at because that's how much it's worth. And so if you're trying to get something that's out of the money, it would obviously be cheaper. With that being said, so that's, in the money on an options contract is anything below the strike price, which is this number right here, or the actual share itself. And the on the money is basically what the share is. So if Apple is actually 132 and not 131.9, on the money would be this $132 strike. The closer that an option moves toward that strike that's out of the money, the more it increases. And so as you can see right here, the difference right here is only 43 cents, but from here to here, it's 61 cents per contract. So that's actually $61. The way that this works is you can actually click these options individually. You can click all of them. And you can see these Greek values down here. So the delta is how much money you make for every dollar that the stock moves. So you'd make 66 cents per contract, 66.42 cents per contract, or $66.42 for every time Apple moves a dollar. The further out of the money you get, so that's actually in the money, right? It's below the 131.9, 131 is below that. The further outside of the money you get, the lower that delta becomes. So what was originally 66 cents now is 49 cents because it's out of the money. And so this is kind of a risk factor that you have to kind of judge. The other thing that you have to consider, the other Greek value that's really important is the theta. So the theta is very interesting value. It's something that basically classifies the depreciation of that specific option contract. And so the point of the theta is to depreciate your contract from whatever its value is right now to zero by the time it expires. So now that you have that in mind, you want to have the least amount of theta and the highest delta. And so the further in the money you get, if we just scroll down here to like $100 Apple call, the delta is going to be extremely high. You're almost making $100 for every time Apple moves, and the theta is going to be super low. It's only $7 a day. And so the reason why I know it's 100 is because you have 100 contracts. You always multiply this number by 100, both numbers. And so you're actually losing $7.82 a day for $100 you make, but it's so expensive. And actually this contract does expire tomorrow. One other way that you can kind of manipulate the theta and the delta is if you get a further out expiration date. Yes, the price does change. Right now it's $593 for this contract, but it does expire June 4th. And the delta, while it does stay the same as the other one, the theta is so much less. And so again, the point of the theta is to decrease the contract by the time it expires down to zero, so that whatever money you make in the meantime, or however much the contract becomes worth, you just sell that and you take your profits. The reason that I say you sell that before the expiration date is because if you have a contract that's in the money that expires, you now own 100 shares of that. Because remember, guys, you are reserving the right to 100 contracts when you first purchase an option. So if it does expire on that expiration date, congratulations, sir, you just owned 100 shares of Apple. And I don't know about you guys, but I personally don't want to be paying for 100 shares of Apple. That would be $13,190. When all I want to do is pay for an option that costs roughly, a little less than $600. So obviously we took a look right here. This Apple contract is worth 5.93. Closer, to the expiration date, you're looking at that same contract being worth 1.45. So the idea here is that the smarter play, and this is not financial advice at all, but the smarter play that most investors would take would be getting something that's in the money but expires in a much longer time. And the same thing for puts. In the money is actually above it. That's why these contracts get more expensive. Out of the money is things below it. That's why these contracts get cheaper. One other key thing to memorize or to remember in a sense is that the closer and out of the money, so if we get a call and we have out of the money, the closer it gets to that actual share price right here, the more not only is this delta going to go up, but the more the contract's going to pay in general. So right now, this $136 strike price right here for this contract is worth only $4. For the right to 100 shares, it's only $4. So while that's cheap, you're going to lose $16 a day. So by the time this hits tomorrow, this contract's going to be absolutely worthless. And the chances of Apple moving up $4 or a little less than $4, because 4 times 4 is 16, that pays for that theta. The chance of Apple moving up $4 in one day is very unlikely, and so this contract may not be the smartest investment for some people out there, but if they believe that Apple will go up, $4 or more, and like I said, the closer this gets to in the money, the more this delta goes up. As you can see, like closer $8, now you're dealing with 16, this is probably going to be 30, this is 49. So the closer that gets to in the money, the more that you start to make. So make sure that you be careful with that. Make sure that you watch those values, and make sure that, one mistake that a lot of, people who are new to options make is holding that contract till it expires, and they don't realize that, oh, I'm in the money, I made a bunch of money. Yes, that's true, but now congratulations, you now own 100 shares of Apple or whatever stock it is that you're invested in. Most people can't afford that, and they end up going broke. It's a very unfortunate thing to see. But that's kind of the entrance to options, and next time we'll go over some covered calls and debit spreads and stuff like that, iron condor methods, but today that's just kind of the basic entrance. I wanted to kind of go over this stuff with you so you guys can understand. And so, for example, the last thing I want to go over is, when I will put a play out there, something that I'm entering in, I will say something like $131 Apple call, expiring April 23rd at 1.45. The reason I say that and the way that flows is $131 strike. It's an Apple call, so you know that you're getting a call, not a put. And it's expiring on that date, and this is the price of it, 1.45. That way you guys can know. It's just kind of like a doop, so whenever I, put something out there that I'm currently getting in, that way you guys can know what's happening. And obviously the other kind of, things right here are pretty self-explanatory. The percent change is just how much the option decreased today, or that's how much the option lost as well. So it went down 38%, or $1.40 per contract, so $140 decrease because it's times 100 again. And so that's actually pretty crazy. That's a huge decrease, And so just be careful with options, guys, whether you're trading them or not. There's something to be wary there of, and make sure you watch out for that theta because it will come and attack you. All right, guys, thank you so much for watching. Thank you for tuning in to Malibu Investing. My name's been Andrew, and I'll catch you all later. Peace out.